Okay, so today we're going to look at average daily range and the differences between different ADR settings in relation to position trading strategies. So the reason I did this analysis was to find out if there is an advantage to using a smaller or a longer time period for measuring the volatility of an instrument. So just to give a little bit of background, within position trading, everything I do with regards to risk and targeting is based on ADR, and ADR stands for average daily range. So all the indicator you can see on the chart here is monitoring is the average daily range, in this case, over the last 10 days for this particular instrument. So you can see on the right hand side here, we have the ADR dashboard, and the ADR dashboard basically gives you a readout of all the average daily ranges for each instrument. So the reason we use average daily range is it's important that you use a correct risk for the amount of movement of a particular instrument. So, for example, we can see on the dashboard here, we've got the euro yen, which has an average daily range of 119 pips. And you can see that up here we have the Aussie New Zealand pair, which has an average daily range of 39 pips. So there's no point in risking the same amount of money per pip of movement on the Aussie New Zealand and the euro yen because they radically move differently during the day. And also for targeting perspective, you don't want to target 20 pips profit on the euro yen and target 20 pips profit on the Aussie New Zealand, for example, because the euro yen 20 pips is going to be about that much movement, and on the Aussie New Zealand it would have to move an awful lot further within its average daily range. So we use average daily range for making sure that we use the right risk on each instrument based on how much it moves. Now, the average daily range of an instrument will move and change over time as well. So as a particular currency pair or commodity or stock or whatever you're trading gets more volatile because there's more interest in it, the average daily range will increase. Therefore, you need to be adjusting your lot sizing and adjusting your targeting based on how much that thing is moving over time. So the study that I've done is basically to see whether or not we should be using a shorter or longer period of average daily range. So each of these lines here on this chart is a day. And at the moment, the average daily range, 100% of the average daily range lines you can see is measured from the high there and the low there up to these levels here. And that is over the last 10 days. Now, if we use a distance measurement of 20 days, we'd be taking into account this area of low volatility here and this area of high volatility. And if we go over a longer period, we're taking into account all of this as well into the calculation. So what I wanted to do was find out whether it's better to use a short or a long period of average daily range, and if there is an advantage in making either more money, having less drawdown, using less lot sizing, etc., etc. So basically just see if there is a reason for changing. I use ADR 10, and a study I did about 4 years ago, there's a video on YouTube about that, told me that the ADR 10 was kind of the happy medium and the best place to be for giving an average for an instrument that changes with volatility and fairly quickly. But I wanted to rerun the analysis using longer periods. So what I've got here is an ADR volatility over time chart. And what we've done is basically taken the average daily range for the last 4 years. So I've done a test using the Position Trader EA and extracted all the data over a 4-year period from the strategy tester to monitor what happens to ADR, so what the ADR figures are. So you can see on the chart here, we've got an ADR 5, an ADR 10, an ADR 20, and an ADR 60. Now, ADR 5 is the last 5 trading days, so that represents 1 week's worth of movement. ADR 10 represents 2 weeks worth of movement. ADR 20 represents 1 month's worth of movement, and ADR 60 represents 1 quarter of movement, so a quarter of a year. 3 months. Okay, and you can see on the chart here, those lines plotted. So the green line, the sort of the dark blue line here, which is this one, which goes all the way up to there, you can see that that is the one with the most volatility, so the spikiest level. And that is because we're measuring the last 5 days of movement. So we're taking the average daily movement over each day for 5 days, averaging that out. And what you're going to get is something that's very, very spiky. Because when there's a news event and you get a big move in a day, that then is a higher range of pips, and therefore your volatility increases and your average daily range reading increases. And then it drops very quickly over time as well. So what happens is you get big spikes, and then as the market volatility drops, you get big collapses. ADR 10 is a little bit more smoothed out. So we're measuring it in the last 2 weeks of movement. So we're taking into account maybe some big news events and some small periods of volatility. So it becomes a little bit more smoothed. Over a month, it gets smoothed again. And then over a 60-day period, a quarter, it gets even more smooth. So this blue line you can see here is the ADR 60. Now, my theory was that using an ADR 60 is going to have a couple of benefits. And the one benefit that I was expecting to find in the results was that, first of all, you would take a more stable lot size throughout that instrument and whatever happens to that instrument, because for position trading, we are risking an amount of money based on an ADR's worth of movement. So that distance basically is where we place our entry and our fake stop loss, if you like, into the market, and that becomes our risk. So if you have a reading that is more steady and stable over a period of time, it means that you'll be taking the same amount of risk the vast majority of the time. If you take a trade after a period of high volatility, so let's say a market moves very hard on news for 2 days, and then you take a trade, the ADR reading is going to be much bigger, meaning that your stop loss will be much larger, meaning that the risk taken on that trade will be much smaller. Your lot size will be reduced because the distance you're placing your stop and your risk is further away. So that's the theory that I wanted to test. And you can see very clearly from this chart that the blue line, the ADR 60, is much more smooth and stable than using higher volatility. Now, there's a couple of points with this as well. Obviously, this is also used for targeting a lot of the time. So if we're going to risk, say, 1% of our account over one ADR's worth of movement, and we want to get out with a profit, we're going to look at taking profit somewhere within 1 ADR to 1.5 ADR of movement in the opposite direction, i.e. in the way that we want to go. Now, the problem with this is if we have a very, very high ADR reading when we take our initial trade, our target will be a long way away. Now, if that volatility suddenly drops down, our target is going to find it very hard to get reached, isn't it? Because when we got in, we were expecting the price to be very volatile and move very quickly, but suddenly price drops down. There's a really good example of that, which we've currently had on the Swiss franc. So we had a move on the Swiss franc recently with very large volatility. So we had a news event where the Swiss franc changed their interest rate without telling us, and we had a massive 300% ADR move in 1 day. Then all of a sudden after that, the next day, the volatility dropped back to normal. And you can see it moved massively quickly in 1 hour. We had a big ADR reading put in on the chart. The ADR massively expanded on the following day, but the candles went back to normal size. So for the candle there to get completely undone, took a day. You can see that obviously when you get in up here, if you've got a high ADR reading, it's going to be a lot more difficult for price to get back to your targets. So the testing that I did was using the Position Trader EA. So all I did was I opened up the Position Trader EA and used the default settings basically to get into some trades using some standard risk settings so that it was consistent across all instruments. And I did a test using 9 different instruments. So what the Position Trader EA can do is export data. So if we look at the data that you get out of the Position Trader EA, it gives us the time of every day in the test. And what it does is it stores the average daily range number. It shows us the balance, the equity, the open profit, drawdown, and some other data which I've stripped out of this particular spreadsheet. You can see here that I've tested the ADR 10, the ADR 5, the ADR 20, and the ADR 15, and the ADR 60 in this particular test. So I wanted to get lots of different data out so that I could see what the differences were. And you can see there's quite a variation in the ADR number. So on this particular day at the start of the test, ADR 10 was sitting at 952, which is 95 pips. ADR 5 was sitting at 66 pips. ADR 20 was 165 pips. ADR 15, 131, and ADR 60 at 104. So there's a massive variation there from 66 pips all the way up to 165 pips. There's 100 pips difference, depending if you're using an ADR 5 or an ADR 20. So that is 1 week's worth of data and 4 weeks worth of data. So if we look at the tests that were done, and the results that we got out. What I did was I ran that test over a 4-year period on the Aussie dollar CAD, Aussie dollar Swiss, Aussie New Zealand, Euro pound, Euro New Zealand, pound US, New Zealand Swiss, US CAD, and the US dollar Swiss. I'm just going to zoom in on this a little bit just so that we can see this data a little clearer on the screen. There we go. So all I've got here is the tests that were performed. I've got a tab down here for each of the tests. So this first column here, all of this data is ADR 10. All of this data here is ADR 20. This is ADR 40, which I decided to use, which is a 2-month period. And then the same data again here for ADR 60. At the bottom of each of these columns, I've totaled up what the results were. So these are the minimums, the maximums, the averages, and the totals. And what data we've got out of here is basically the profit, which is what we're interested in. How much money did the test make? What was the drawdown on any one given day, i.e. every position that we get into can last over multiple days, sometimes multiple weeks. So what was the maximum drawdown we achieved on the account? How many lots did we have open as a maximum? And how many trades in total were open in each of the positions? So these are the things that are important to us as position traders. So here is the data and here is the results. Now I've color coded this basically. Green is going to be better, red is worse. So as you can see here, we've got the first column that we're looking at over here is maximum drawdown. So as a position trader, we're holding positions over a long period of time. We don't use stop losses. Now, this particular test doesn't do any drawdown control at all. It literally is just getting into the market and getting out of the market and holding those positions until they become profitable. So these are basically sort of benchmark tests, if you like. Obviously, there's a lot that you could do to improve them by using drawdown control, using partial closes, all the sort of stuff that we do daily in the live rooms and position trading. But what I've done here is use a standard test so that we've got a level playing field for all instruments, just to see what the impact of ADR is. So your maximum drawdown here, we're looking for the lower number. So the lower numbers are going to be better, meaning we've got less drawdown, less pressure on our account when moves go against us. So as you can see here, using ADR 10 on all of these pairs, it's quite clear that either ADR 10 or ADR 20 gives the lowest drawdown. Now, you've got the odd anomaly in there, like the New Zealand dollar Swiss here, which actually had worse results with lower ADRs and much better results with higher ADRs. But the vast majority of the pairs, as you can see here, Aussie dollar CAD, Aussie New Zealand, Euro pound, pound US dollar Swiss, they all did better using ADR 10. So you had less drawdown when you're using higher volatility measurement. ADR 20 was also very good for the Euro pound, Euro New Zealand, US dollar CAD, US dollar Swiss. So again, much better to use lower ADR. So lower ADR settings will give you less drawdown on your account, which is something that's very important as position traders. The other thing that ADR will affect is the lot size. So the higher the ADR figure, the further apart when we take a trade, our stop loss will be placed. And as our risk is calculated over that distance, the lot size will be smaller if the ADR number is bigger. So I wanted to test to see if ADR has a big impact on the overall lot sizing that we're going to be using. So the more lots you get into, typically the more drawdown you're going to have on the account. However, the more lots you get into, the faster you'll be able to exit those positions as well. So there is a plus as well as a minus to using higher lot sizing. As you can see here, the red is a higher lot size and the green is a lower lot size. So you can see here with ADR 10, you are going to be getting into higher lot sizing. And I'm not quite sure why that is, but in all the tests, it's shown that you do take higher lot sizing when you're using a lower ADR figure. I was anticipating that number would probably come out as a smaller number, because if you're using a wider range, your lot size should be smaller initially. But what I suspect is, because we are using this wider range and taking a smaller lot size, it takes a lot longer for these trades to actually achieve target, meaning you will tend to go into more drawdown and hold the trades for a longer period of time. So it actually works out that you're going to get a better result using a higher ADR. So anything from an ADR 20 upwards is giving you much more green areas with most instruments, meaning that you're going to get less lots taken per trade if you use a higher ADR. So that kind of conflicts that. We're looking at, if we want a low ADR, a low drawdown on our account, we should be using a low ADR figure. But if we want to use lower lot sizing, we should be using a higher ADR figure. This is the maximum number of long lot position that we had on, the maximum number of short lot position. And as you can see, it's a very similar result across both of these. So for longs and shorts, they're going to get roughly the same. So we got reds here, a lot more reds here, and a lot more greens here. So basically, ADR 20 to ADR 60 means you will be getting in with smaller lot sizing. The maximum number of trades is the maximum number of trades within a position at any one time. So if we quickly go over and have a look through one of these results. So this is the US dollar Swiss. You can see that basically here we've got one trade on, we hold that one trade for 2 days, then we added a second trade, which we held for 2 days, then we added a third trade, which we sat in for 4 days, then we added another one, and then another one, and then another one. We got up to 8. So the maximum number of trades in that position, which was held for 1, 2, 3, 4, 5, 6, 7, 8, 17, 18 odd days, was 8. So we took 8 trades within a position and we held it for about 3 weeks, and then we exited the position with a profit. Okay, so that is what that's measuring there, the maximum number of trades. And as you can see, there's quite a variance here, which is spread all over the different ADR periods. So sometimes using a higher ADR, you're getting less trades. Sometimes using a lower ADR, you're getting less trades. And in the middle here, you've got also instances where you're getting into less trades. So not really much advantage there from a number of trades perspective using ADR 60 or ADR 10. Doesn't really make any difference, does it? Profit. This is what we're all interested in. How much money can you make? And does the ADR number have an impact on the profitability of the strategy? Now you can clearly see here that this right-hand column with ADR 60 is an awful lot more green than all the other columns. We've only got one red in there. So the Aussie dollar Swiss was the only instrument during this test where you actually made more money using a lower ADR period than you did with using a higher ADR. But we look at the difference there. This test result gave me $7,700 of profit as opposed to $8,900. So it's about $2,000 profit there, which is a fair old variance. But if you look at all of the other instruments, it's quite clear that using ADR 60, a longer period of average daily range, gives you more profit overall. So ADR 10 is the one that made the least profit. But if you look at these figures, you can see there isn't actually a massive variance across them. So from ADR 10 to ADR 60, you're looking at the difference between 6,000 and 7,500, 9,000 and 7,700, 6,200 to 6,900, 20,000 to 23, 10, 4 to 10, 8, 24, 24, 22, 13. So this one here is really the only one that has a massive variance in profitability, New Zealand dollar Swiss. And we know that the Swiss franc is one of those instruments that can push and squeeze very, very hard because it's a safe haven currency. So that one is a lot more volatile. As you can see, it also got into the most drawdown as well. And then we got US dollar CAD 18 to 17 and 13 to 14. So what's the conclusion? Is it better to use an ADR 10 or an ADR 60? Answer is, doesn't really make any difference, does it? So my findings on all of this testing that I've done are really, if you want lower drawdown, ADR 10's better. If you want slightly more profit, ADR 60's better. If you're looking to get into less trades, doesn't really make any difference. And if you're looking to limit your lot size, ideally a slightly higher ADR. So that's good. That's good. These are all in the middle. Not really an advantage, is there? What I was hoping to find was that one of the ADR periods that we could use was going to give us a much clearer advantage, i.e. much lower drawdown, much higher profitability, or much lower lot sizing, or taking less trades, i.e. getting out of them faster. But there is no consistent result across the testing that I've done on these 9 instruments that really says you should be using one above the other. So as with everything in trading, and you'll hear me say it all the time in the live room, there is no better or worse. There is just different. Sometimes you will be better off using an ADR 10. Other times you would have been better off using an ADR 60. But there is no clear winner here. There's no clear advantage to using a lower ADR over a higher. So for me personally, from the testing that I've done and the results that I've got here, I'm going to stick with ADR 10. That's what I've been doing for 4 years. It's been working extremely well. And that is what my initial testing 4 years ago that I did over 28 years worth of data told me was the best one to use. So all I've done here is I've run a test, which is rerunning what I did 4 years ago. But instead of using low ADRs, I've decided to test high ADRs. And conclusion is there's no real advantage. Okay, so hopefully that's helpful. Any of you that have been in the live room knew that I was doing these tests. So that's the results. I thought I'd cover them in an individual video, basically, so that it's up there for anybody that asks the question in the future. Feel free to join me in the live rooms on a daily basis. And I'm in Discord and Telegram if you need me as well. And there's plenty of content on the website to have a look at as well. And everything's going along the bottom there. So go and check it out. All right. Thanks for your time. And yeah, stick with ADR 10.